Good afternoon, everybody. Thanks very much for joining us today. We want to speak a little bit about integrating ESG into portfolios, into portfolio construction. And today we are very lucky to have a number of practitioners here who get their hands dirty with ESG on a regular basis. And on this basis, I would ask each of our panelists to introduce themselves.
Hello there, my name's Ian Webster. I'm a Senior Managing Director at Axioma. Axioma is a software company that builds portfolio construction software and also builds a number of sophisticated indices with partners. And our particular interest in ESG is that over the course of the past few years, more and more people have wanted to integrate the various ESG scores into their standard portfolio construction process. And we've been doing quite a lot of research on how the best way to do that is.
Is it working? Oh. Hi, my name is Shin. I'm a portfolio manager at Client Portfolio Solutions within BlackRock. We do asset allocation solutions for multi-asset mandates.
Hi, I'm Barron. I'm head of index equity and factor-based investing products at Legal & General. Focus on setting portfolio management strategy and developing client portfolios.
So good afternoon, everyone. My name is Pavel Janus. I'm heading the passive research team for UBS Global Asset Management out of Zurich. Just very briefly, UBS Asset Management manages approximately 330 billion in assets in passive strategies. About 60 billion is managed through ETFs, and a substantial portion of that is already in the strategies which are labeled as sustainable. That's approximately 10%, and it is indeed one of the fastest growing segments in the ETF space. We do want to grow, we want to innovate. That's why I believe we are also here. We do have very exciting pipeline, also including some developments with index providers such as STOXX. Thank you very much for having me here.
Thanks very much, everybody. So during the day, we've heard about how ESG is snowballing. It's being used widely. We've talked about regulation. We've talked about how do people see ESG being introduced into their portfolios, into their investment thinking. We've seen that there's been derivatives launched, and it is actually a very exciting space at the moment to work in from an ESG perspective. My first question to the panel would be, and probably more towards EJ, is that from large asset owners, how do they look at ESG? Because it's not all rosy, right? We have challenges as well, many challenges. But how does a BlackRock of the world go about looking at ESG and thinking, what is going to be, how am I going to build a sensible solution for my client base?
Yeah, so as you probably have seen in Larry's letter to CEOs, having a purpose as a company is something we take very seriously at BlackRock. So for instance, a firm-wide ESG integration is taking place at the moment. Each investment team was asked to come up with the ESG policy around our investment and risk management processes last year. So as we speak, we are in the midst of implementing our strategies and measures we had set out for those things. But we're doing this not just for our clients, but for ourselves as well, because we think that it's a sensible decision as a fiduciary and as a long-term investor. So our tagline is that ESG is going mainstream. It is no longer a niche market thing. Besides regulatory momentum and increasing client demands, from an investing perspective, there's an increasing awareness and evidence around ESG factor as a source of alpha over the long term, and also is something that that can help us mitigate portfolio risk, especially to avoid unnecessary risk within your portfolio in the downturn economy. So for many years, a lot of investors saw sustainable investing as a risk to trade off. For instance, the first question they would ask is, so what's the loss that I have to stomach? And our thinking is that today, probably none. Probably you will get more yields over the long term, thanks to more granular data sets available, how controversial they might be, and also enhanced technology that allow us to run more enhanced analysis. We don't need to worry about those losses anymore. So on the client side, we're seeing retail and wealth clients coming to us asking for a specific solution, be it carbon reduction or plastic reduction or climate change risk themes, or in the case of pension clients, they're coming to us asking how can we incorporate ESG into our pension schemes. So we are actually exploring with our clients how to integrate ESG factors into the capital market assumptions, which is the framework that we use for asset allocation solutions at BlackRock. So these are the trends and some of the puzzles that we're trying to solve for with our clients at the moment.
Thanks.
I don't know, I did just respond to that, because I think you've raised a whole slew of different terminology that essentially needs to be unpicked, I think, to be able to understand exactly what's happening. You've used, is there alpha or is it a risk score? And we certainly see within our client base a big discussion about whether there really is alpha in there. But before you can even ask that question, one's got to understand what the there is. So you're talking about looking for very specific solutions for particular clients. And I think that that's the crux of an intelligent discussion, is what solution is one actually looking for? Looking for just a ESG portfolio is an extremely difficult thing to do, because nobody would be able to agree on what an ESG score looked like, and therefore nobody would be able to agree on what an ESG portfolio might look like.
Yeah, and I would just echo that. I had a client meeting this morning, so I'm very fresh and prepped to discuss ESG. But the big question was, okay, let's say I set the same rules in the index, as in I'm just going to cut the bottom 20%, or I'm going to tilt towards the best ESG providers. And they asked, what happens if I pick MSCI versus Sustainalytics versus Elgin? We've created some fancy ESG scores. And they asked, what would happen if I picked any of those inputs? And the answer is wildly different things. And that is a dangerous game, potentially, that I think clients need to spend some time unpicking what goes into that final ESG product. We did a quick analysis on just US companies, looking at some of the major providers of ESG scores, and found that the correlations between that final ESG score across the providers is about a 30 or 40%, depending on the period you're looking at. That's pretty low, and that could lead to some different portfolio results. Our view typically is you should align your belief system with maybe how that ESG score is constructed, is one way to kind of do it. But it gets to this kind of concept where you may not actually have a benchmark in this space. And in preparation for this, and I think this is a big trend that we're seeing, is the game of scale and having everybody in a nice one neat product is probably gone for the CSG space. I think we're going to see a lot of customization, small tweaks, and maybe turning it on its head and thinking more about objectives and less about the ESG score, as in achieving carbon footprint reduction. But that's, I think, the big trend that we're seeing.
Well, if I just may add two cents from our side, where we do see indeed a growing interest and demand from investors, and it doesn't really matter whether it's an institutional investor or a wholesale type of investor, is a need for transparent reporting, basically around the sustainable metrics, basically, right? So on the one hand, investors want to understand, once they pursue certain ESG type of strategy, let's say it's exclusion, they want to see if indeed the portfolio manager, whether this is passive or an active solution, does deliver on the objective. So basically you exclude the stocks in line with the commitment or with the objective. This is only an exclusion component. Now if you go to the more sophisticated type of strategies, like if you want to integrate, let's say, norms such as United Nations Global Compact norms, then the question is, do indeed the index, right, or the strategy does deliver on the objective of eliminating the stocks that, or the companies that do not adhere to these principles. And the whole thing gets utterly more complicated if you go to the more sophisticated strategy. Just an example, we very recently issued an ETF that provides an exposure to bonds issued by multilateral development banks. So these are the bonds issued by organizations such as Asian Development Bank or African Development Bank or the World Bank Group. And here, of course, the question is that, how do we investors understand whether the proceeds are, used indeed, in line with the objectives, right? So we are working now, very hard with these organizations to understand how to aggregate this, because this is an ETF, it's an index base, it's a very diversified portfolio, but how to, combine all the data and build a certain standard so that we can service investors. They understand indeed that the proceeds are, used in line with the objectives. So there is a lot of challenges around these topics as well. It doesn't really matter whether this is institutional investor or the wholesale investor.
So just adding on to that, I think there's a movement away from the headline ESG scores just precisely because of the reasons that you mentioned earlier. So in the case of BlackRock, we actually look at 7 different vendors. And then what we're trying to do is actually go deeper than ESG headline scores and then take a look at the raw data sets. So, and come up with our proprietary ESG scores for certain issuers, be it sovereign bonds or equities. And I think what clients want to do right now is that they kind of start with the screening because they're tapping into the water. They don't know what they want, but they want to provide a certain indication to their boards and their customers that they're working on it. So they start with screening and then carbon reduction targets. And then if they're more advanced and if they become more comfortable with the language around ESG, then they come up with more of a thematic approach. I want to promote more electric vehicles. So for instance, BlackRock launched ETF with STOXX on electric vehicles. And then if they're more advanced and if they have a strong conviction around ESG score, then they would like to enhance the ESG score of their portfolio at the aggregate level. And the most advanced investing type would be impact investing, but that's the uncharted territory right now that everybody's trying to get at. But we're starting at the screening process because everybody's at the baby step. And to your point earlier, everybody's trying to figure out what to do given the mandates coming from the regulatory bodies and then client demands. So yeah.
Yeah, one of my colleagues did some research, and his premise was when you're building a strategy, your first objective is really to do no harm on your performance. Is that we can talk a lot about this notion of objectives, but as a fiduciary, one really has to maintain your performance level. And I think his research showed that certainly over the past few years, you wouldn't have that negative impact that you talked about by exclusion or screening. However, the data sets are very, very limited to see this. And there was some sort of underlying perhaps belief that this was perhaps even more of a flow analysis or a momentum analysis than it was actually underlying ESG outperformance. Because as people got more interested in the ESG scores and the ESG factors, they were, by definition, pricing themselves nicely in the market. But that first notion of do no harm from a fiduciary responsibility, I think has to be at the bottom of any discussion that one has here. Otherwise, you really are taking on that activist view that says, I'm prepared to do away with some performance in exchange for some very specific view that I want to impact on the economy.
I think the panel has really summarized it extremely well. We have granular data available to us. We have more sophisticated investors who are looking for what we at STOXX call integrated solutions. We are definitely moving towards, I would say for the last 2 years, we've essentially been building ESG indices with some kind of a low carbon or a climate overlay, because this is what the market is requiring. As EJ mentioned, we are definitely seeing more thematic themes coming out. We're seeing quite a lot of themes coming out of the E space, for example, especially from Europe, where we see a big demand for people who want to, or for clients who want to have a specific theme that you can target by using specific KPIs. So I completely agree with the view that we are moving away from the ESG scores as a quick and dirty, so to speak. And I think it's very interesting that not only the index providers, the data providers, all our clients, everybody is actually understanding the data much better now. They understand what can be captured. They understand how to live with this data now. They know if I have to turn this dial up, what is going to explode on the other side of the equation. And I think this is where it becomes really interesting for us, because if we use sophisticated software like what Ian and his company is providing, we can now really start to do, I would say, proper empirical research in terms of, are we really capturing what we are saying we are capturing? And I think a lot of criticism that has been leveled against ESG is always greenwashing is the easy one to go for. But I think the concepts that we are seeing at the moment are significantly superior to what was around 3 or 4 or 5 years ago. I mean, it's in my view, it's incomparable now.
But it's not good enough.
Absolutely
it's clearly not good enough
Yeah.
in the sense, as you were suggesting earlier, you look at all the correlations between the various different scores just not being there. And the sort of, even just the vast majority of this data is self-reported. Is it being audited? How do you actually define the various factors? And I think that the notion of setting some standards, like accounting standards, not necessarily regulatory standards, but like the accounting standards that one has, gives at least some view that company A and company B, when they're reporting a specific number, are talking about the same thing.
Yes.
I don't think very many people have that confidence in the data at this stage to be able to confidently say, when I say this and when I say that, I'm saying the same thing.
Yes.
Yeah, and I would echo that definitely, and that makes the portfolio construction so critical. Is how do you construct a portfolio that makes sure it's taken into consideration the potential of some data fallacies? And I think even if you look at some raw metrics, not to scare everybody, but they're also fairly low correlations between them. Why? Because of all of the NA assumptions that a lot of your data providers are making. As in, this company doesn't report, I'm going to assume it's the industry average or the subsector average. That doesn't mean this isn't good to integrate from a portfolio perspective. We at Legal & General have a handful of products in our future world range that's focused on delivering these kind of outcomes, but it's more of an education that's required, I think, for the end user of, beware of the unintended consequences that could result if you're not paying attention to the specific construction in these products. That's why, integrating it with a factor portfolio or taking some tracking error considerations into is an important way to construct. On the data point, this is always my favorite example is Tesla is a great one. That seems like a good ESG company. So one vendor, 9 out of 10. But someone else says the way they get their lithium is actually pretty poor, and they've got some dodgy human capital practices as far as how they treat their workers, so some labor force violations. So actually they're a 2 out of 10. So you got one vendor, 2 out of 10, one vendor, 9 out of 10. It's up to you to decide how you view Tesla, and that's all about aligning yourself with that key data vendor.
On your point, Willem, on understanding the data, I think indeed there is a great understanding of the ESG data, and that has happened over the last 2 or 3 years because of the availability of this data, also including the index concepts, right, which basically kind of push the transparency. One of the key concerns we do here is the consistency between the ESG data across different ESG raters, right? And here is a research question open to all of you, right? I'm wondering whether we had a convergence of ratings, for example, in the credit space when Moody's, Fitch, and S&P started to introduce kind of credit ratings, let's say in the 60s. I doubt that. I think there was also, at the very beginning, kind of a learning process, basically, how to assess in the best way kind of credit fundamentals and what different metrics mean indeed for credit risks, right? And the same now probably holds true for ESG raters, right? What kind of underlying metrics are the most pivotal for the companies that are exposed to the ESG risk? I think there will be a greater harmonization. As for the research on performance, I think, as always, we do have quite a lot of progress in the equity space. I think equity type of investments are now quite understood. People understand that ESG factors correlate with other equity factors such as quality, to a certain degree size or low volatility. I think there is, of course, a less of a research in the fixed income space. What does this really mean, right? And not to mention, other asset classes such as real estate or alternatives. This is basically, kind of a still uncharted area. And if you are talking about, constructing sustainable portfolios, I think there is considerably more to be done in the asset classes beyond the equity for sure.
But I think maybe digging into a little bit about the discussion between the correlation between ESG and size, that can be argued that that's purely a reporting bias, is that if you look at the major providers of ESG data, they're only providing data for the very largest of companies. And go back to the point that's being made about the self-reporting, whether that's null or whether it isn't null. You've got to have a certain investment in a corporation to be able to report at the level that a lot of these ESG providers require. And so I think you're absolutely right that comparing it to credit ratings, comparing it to industry and sector standards, comparing it to risk premia is a good way of thinking about it until you think about, well, value's been around for maybe 100 years, and you get half a dozen value managers sitting on a stage, and they'll still be arguing about what they mean by value. My suspicion is that in 100 years' time, we may still be arguing about what we mean by ESG.
Mm-hmm. But I think precisely for that reason, I think having this discussion and having this awareness is important. Mm-hmm. So for instance, in the case of BlackRock, when we did the back testing analysis on equity portfolio, the world portfolio, what we found is that there is a definite tilt towards value and quality and low vol for high ESG rated issuers. And then there is a tilt towards momentum for low ESG rated issuers. But having that understanding, if you know that context, you can source, and if that results in outcome unintentionally, more defensive portfolio as a result, then you can always factor that into your consideration and source your risks from somewhere else. Yeah. So I think precisely that's why having this discussion and starting to run this kind of analysis is important, because it's imperfect. Everybody knows that, but we're in the beginning of the journey. But we need collective intelligence. That's why we're here today.
How many years can you manage to backtest? How much history do you have?
So we could go back to back into 1994, but because of the emerging markets, we made two cuts, one for 94 and then the other one for 2012. And that's, I think, the industry standard that MSCI is recommending, because the more reliable resources are available and data sets are available from the emerging markets starting 2012, and because there are a lot of stitching going on.
Yeah, and of course the big challenge there, as we were discussing before the panel, we've seen one economic regime since 2012. We've got no idea how these things are going to perform in different economic regimes.
Yeah. I think as practitioners, we are probably starting to put more pressure onto our data providers. We're asking and demanding more from them, because we are saying, look, the space is evolving. There is a lot of assets behind ESG type of strategies. Our clients demand deeper understanding. They want to have consistency. I think it is always interesting to look at the different providers and philosophically how they differ in terms of how they view ESG. I think this is one of the main reasons that are driving these big differences in terms of how companies are rated. But I think the pressure on the data providers will just continue. I would be interested to hear your views on where do you think is the next innovation going to come from an ESG perspective? Everybody seems to be going towards applying some sort of a risk metric in their weighting. How do they view the risk of a particular company? I think this is, from an ESG perspective, will become also very complex when you think about climate. If you think about physical risk, I know you can bring it into the E part, but it is probably going to become one of the more important E parts, I would say, as we move through time. So I would be interested to think, if you think about it, how do you think the ESG data will evolve? Do you think there will be a lot more ESG data providers coming out with extremely granular and extremely specific and specialized data sets? Do you think there will be consolidation in this space? And where do we think this is going to lead in the next 5 or 10 years with this enormous pressure on everybody?
Yeah, I'm happy to jump in. I think the last one's the easy one, the consolidation. You're definitely going to see a lot of that. We've already seen some of that. I think for us, the big thing, if you think about ESG in general, you can kind of bifurcate what you're hoping to achieve maybe from the alpha potential generation that I think a lot of people are looking at. But the way we view it is one of the big benefits to this collective investment is the fact that you're incentivizing companies to behave better, right? You're incentivizing some change. And so for me, one of the big trends that we'll see is more people linking these raw metrics and these scores to their engagement policies. to get the kicker so that capital allocation follows with good behavior. And I think that's the real interesting part for me, is that collectively, if we can incentivize the bad behaviors, start disclosing climate policies, start addressing climate risk, changing compositions of boards, having one share, one vote policies. If the markets start to adapt, there is a lot of research that's supportive of those type of individual company behaviors. And then suddenly, 5 years from now, and I agree there's going to be a lot of inconsistency on approach, but potentially we've raised the boats so that even the investor in the market cap index experiences an uplift in good company behavior. So that's a trend that we're hopeful for and are pushing from our perspective.
Yeah, and I think that, as you say, that transparency on what the data actually is vitally important. Is that I think we're going to have to live with inconsistencies for the foreseeable future, and we're still going to have to keep the 7, 8, 10 vendors for some considerable time, but you've got that transparency. I think the shift that we're hearing from some of our clients is about materiality, which is, okay, we've got this score, but is it actually material? And is it going to help us with our performance? Is it going to hinder us with our performance? Or is it just a number that's out there that is the latest marketing term? And I think there's quite a lot of more work that needs to be done to understand the materiality of any of these numbers that are being collected.
I do think innovation, just referring to your question, innovation in the ESG data space will be like truly across the board. I mean, I hope this is not a winner takes all economy, right? You need the heterogeneity of methodologies, you need the heterogeneity of assessments, and then in the end, it's investors basically who can decide also, what is more compelling and convincing to their objectives. And for the innovation, I think what we think is you're going to have certainly more demands on real-time reporting, basically, right? So investors want to understand in real time not what are their financial risks, but what are their ESG-related risks, right? This is not yet available to the scale that investors probably would be demanding, right? That's one aspect. Second aspect is I think there is still more metrics to be embedded into the methodologies, which are more forward-looking. But of course, the forward-looking component is very hard to factor in, basically, right? But that's the best what would you have, right? Because if there is a certain predictive power in these metrics, then managers can hopefully manage the ESG-related risks. And for the innovation, let's say from the investment side, I do think we will go a little bit more towards the measurement of how investments, help to achieve certain SDG goals. So this is what we do observe. So investors, who let's say buy certain ETFs, they also want to understand. Okay, I have this exposure which excludes. On top of that, it has this norm, values-based screening, and does the best-in-class approach, for the sake of example. But how this does, relate to my SDG goals, right? How to measure the impact? What could be the metrics? So we try also to help investors understand this type of relationships. This is, I think, a very challenging domain, basically. How do I measure that my portfolio indeed helps to reduce poverty, food nutrition, water scarcity, better gender and stuff like that, right? So there is certainly more to be done in that space going across the line.
In the case of BlackRock, in terms of innovation and future direction of the industry, I think we're visiting the topic of ESG more from building a future-proof portfolio perspective. Because there are mega trends that are happening, and ESG tends to be, or happens to be, one of the mega trends. And there are inevitable changes that are happening, and we're seeing some paradigm shift in our society, one of the biggest perhaps since the Industrial Revolution. And we need to be prepared for those changes. And because climate change risk is one of the critical ones that everybody's paying attention to, because otherwise nobody will have a home in 10 years, according to Greta, we're trying to pay more attention to stress testing scenarios around climate change risk. So for instance, we're looking at our portfolios through the lens of climate change risk by running carbon tax scenarios. And then also taking a look at our portfolio from the low carbon economy transition perspective. Who are going to be the winners? Who are going to be the losers in the future? And then making bets on those analysis. And also trying to raise more awareness around this topic internally by running the reporting amongst ourselves and just taking a look at the snapshot of ESG scores as well as the carbon metrics, and doing the same thing for our clients, because having this dialogue is very powerful. And then collectively, together, we will decide the future path.
So as you can see, we are all extremely passionate about this topic. We can probably speak for the rest of the afternoon. Unfortunately, I think we're coming towards about the coffee break for the afternoon. So if this didn't wake you up, I don't know what would. I would really like to thank the panel. This has been an excellent discussion, and we would like to open to the floor for any questions.
Thank you very much for a very interesting discussion. What do you think prevents asset managers from supporting higher levels of climate-related reporting proposals? For example, reporting on CO2 emissions, exposure to climate-related risks. I don't want to point any fingers.
So the question was, what prevents everyone from voting for?
What prevents the asset managers from, because obviously there's not 100, the asset managers don't go 100% say, we want you to disclose. I mean, the highest is probably LGIM at about 85%. You know, so, and obviously there are other asset managers who are a lot lower.
There was a piece in the paper today about, you were talking about Larry's letter to CEOs. He was spoofed earlier this year, where a letter went out from a group called the Yes Men, saying that precisely as you were arguing, and he wrote back enormously around it. And I think it's a very, very tough decision. As an asset manager,
yes, it is,
it's not your money.
Yes,
it's ultimately an owner's decision about what one should be doing, as opposed to the asset manager pushing that as a particular agenda. The asset manager has a fiduciary responsibility to the owner, and if the owner wants that, then they're going to push that through their asset managers. And we're all owners, so don't necessarily push it into the asset management sphere. Push it back on oneself about how do you invest? How do you look at things? How do you push your pension fund to invest?
I would argue that actually these risks and opportunity, ESG-related risks and opportunities should be looked at as part of fiduciary duty, actually.
Yeah. Absolutely. Yeah, no, I mean, it is something from an index business, how do we differentiate? And one of the things that we always talk about is passive investors, active engagers. And that's just critical to kind of our pillars and probably why you see some good voting records. So thanks for that. But yeah, it's one of those interesting things because you said, not your assets. And I think, we try and put those assets to work. I think the market is starting to turn in a good way and realizing that, there's a lot of, especially passively, you look at the aggregate position from a BlackRock, Vanguard, State Street, Northern, go down the list, include UBS, and we have a pretty big footprint in passive tracker funds. And what we do with those votes is critical. So I think hopefully the trend continues.
So yeah, adding on to that, I think that's why BlackRock, in the case of BlackRock, is putting a lot of emphasis on the importance of stewardship by engaging with companies, by engaging systematically the proxy voting in the right way. Because as you mentioned, it's not our money. Unfortunately, we can provide it with options, carbon reporting or carbon reductions or no weaponry, for instance, for index products as well as active products. But at the end of the day, our clients actually have to come to us. These are the ones that we want for our portfolios. We cannot force them to do certain things. So we're working really hard internally to come up with those suggestions and options. Because you don't see the carbon reporting yet, it doesn't mean that we're not doing anything behind the scenes. We're just preparing for the future. So.
Maybe a last question, yeah.
Sorry about that. I was wondering, what is your view on alternative data sets? For example, we now have machine learning and big data analytics. And do you think that could help us in order to get a more forward-looking view? And also, what's your view on the traditional vendors actually integrating such methods in their analysis?
Well, maybe I can add to that. I think this is already now pretty much happening in the industry. I mean, from the methodological point of view, I think methods are already out there. I mean, the entire machine learning, developments, methods are out there. Artificial intelligence methods are out there. Data sets are also out there, and I think there is first attempts, indeed, to try to understand whether you can extract real-time signals, basically, let's say from social media or from some other sources related to climate risks, for example. Whether they can be material for certain ESG-related risks. I think there is a big potential there. I don't know how substantial that will lead to the, let's say, emergence of new providers, or whether the existent ESG raters, they will utilize this. I think probably both will happen.
A point to your question on disclosure by asset managers. I didn't know that this is a bit of a Darwinistic discussion style here. So anyway, just to remind you, the PRI has asked all signatories to disclose upon TCFD by 2020 as part of the PRI annual assessment. A. B, the European regulation requires climate disclosure for all benchmark providers in roughly 2.5 years on Paris alignment, concretely. C, already, for example, we are, as Allianz Global Investors, who are one of the leading providers in the French market, so we had to produce Article 173, it's technically called, climate reports for over 260 portfolios, which means carbon footprint, share of green revenues, transition risks, and so forth. So it is, there's a lot happening, and the question more is, to me, what do you do with the information? Because what's a bit shortfalling here is, for example, carbon footprint is a good start, don't get me wrong, and you need it, but it's typically -2 years old. It's only scope 1 and scope 2, so the downstream carbon emissions you don't get with that metrics. So for example, you get Airbus or Daimler being low scope 1, 2, but scope 3 is high. So the question is more about innovative climate reporting and disclosure, point taken here on looking more at transition opportunity and what's happening forward-looking. Thanks.
Thank you. And actually, a very last question that came through the app. There were a couple of questions, but one that seemed to be an interest of the greatest. What parameters can funds rely on to call themselves ESG funds? Probably either for you, EJ, or Dr. Pavel. Or
This is what, yeah.
Have we got another hour to go on this?
Yeah, that's a good question. I mean, for me, that you put it back in the eye of the beholder. If it's achieving your individual objectives, I think that's good enough for me. That's where I draw the line. Percentage of improvements, that's hard because are you integrating some other objective? Are you focused on a particular region? It can't afford you significant improvement. So there's all sorts of construction decisions. Then ultimately, our view is, tell me what you want to achieve in this product. We build you a product that achieves those goals.
And as the only person who doesn't have a fund to support, I'll make the comment that I think ESG is an extremely important marketing umbrella, but it probably shouldn't be looked at as much more than a marketing umbrella, that one needs to go down into the detail to understand precisely what it is you're looking to invest in. If you want to stay at that high level of ESG, we're forever going to be discussing what do you mean by that.
Well, I think there is a number of ESG strategies out there, right? And there is taxonomy already existing, going from, let's say, exclusion through negative screening, positive screening, integrating of the norms, ESG integration, and then to impact, right? If you look at the fund, basically, and whether the fund can be indeed labeled as ESG, you have to basically understand what is the objective of the fund in this taxonomy. And we, let's say, in the passive space, we have to often rely, on the indices and their methodologies and the underlying ESG data, and asking ourselves the question whether indeed the index, in this case, delivers on the objective, right? So let's take, for example, if you have, let's say, a low carbon index, right? The question is, okay, what kind of a metrics should be used or applied as a measurement of the carbon intensity? There is, of course, a number of metrics out there. Where is the underlying data coming from? Who validates this data? Is there an audit, et cetera, et cetera? And then in the end, to look whether such a strategy delivers on the objective versus the market cap of indices, whether it decarbonizes. So basically, it's understanding the objective of the fund in the passive space. Is basically you can relate this overall taxonomy and classify indices across different strategies, and basically monitor whether the fund delivers on the ultimate objective, basically in the ESG space.
Yeah, I think everybody's kind of in the industry is waiting for the European Commission to come up with the taxonomy around ESG, and then Fellow-Fin, for instance, in the case of Belgium, they came out with the ESG labels, what constitutes ESG. So those little things kind of set the tone in the industry. In the meantime, to close the gap, I think all of us are working towards having some sort of baseline screening or ESG targets that clients are happy with. And of course, that starts with, be it indexed or active, you have to start with engagement with your client. You have to ask for their objective first. And if that's their definition of ESG, you have to create something for them. So, yeah.